The human brain is optimized for survival, not for probability. When you enter the market, you are not just managing capital, you are managing a delicate neurological ecosystem. Most traders believe their greatest asset is their system. In reality, it is their psychological capital. Imagine two doors. Behind the first is a predictable, structured environment where effort correlates directly with reward. Behind the second is an environment of pure probability, where the same input can yield entirely different outcomes. The market lives behind the second door. Yet, our biology insists on treating it like the first. When you experience a loss, your brain registers it not as a statistical variance, but as a direct threat. If you experience a second consecutive loss, an invisible threshold is crossed. Your biology changes, your heart rate shifts, your cortisol levels spike, and the prefrontal cortex, the seat of rational decision-making, begins to cede control to the amygdala. Professional traders understand a truth that retail traders ignore. After two consecutive losses, you are no longer the same person who designed your trading plan. You are compromised. The decision to stop trading after two losses isn't about protecting your wallet. It's about protecting your mind. Because once the mind is broken, the wallet follows automatically. Stop here, before it's too late. The anatomy of a biological trap. To understand why the third trade is the most dangerous event in Trader's Day, we must look at what happens beneath the surface of conscious thought. Behavioral economists often talk about loss aversion, the reality that the pain of losing is psychologically twice as powerful as the pleasure of gaining. In active trading, this asymmetry multiplies exponentially. After a single loss, you can rationalize. Tell yourself, it's just part of the distribution of outcomes. The second loss challenges your competence, creates a psychological debt. Human mind loathes being in debt to reality, demands a resolution. This is where the brain plays a cruel trick on you, begins to look for patterns that do not exist, creates a false sense of urgency. The urge to enter a third trade isn't born out of a clean market signal. It is born out of a biological compulsion to erase the discomfort of the previous two outcomes. You aren't trading the market anymore. You are trading your own internal state. The illusion of the recovery trade. Let's look closely at the mechanics of that third execution. Call it the recovery trade, but its true name is revenge trading. It wears the mask of analysis, but it is driven entirely by emotion. When you look at the chart after two losses, your perception is narrowed. This is an evolutionary survival mechanism known as tunnel vision. In the wild, when a predator threatens you, you don't look at the beauty of the trees. You focus entirely on the threat. In trading, the threat is the loss. Therefore, your mind focuses exclusively on data points that suggest a fast recovery, while completely blinding you to risk. You begin to tell yourself dangerous lies. This asset has dropped too far. It has to bounce. The market owes me this setup. If I just get this one right, I'm back to break even. Notice the language of that internal dialogue. It's the language of a gambler trying to break even with the casino, not a business owner managing an edge. Professional traders don't look at a loss as something that needs to be fixed immediately. They view it as a cost of doing business. If a restaurant throws away spoiled ingredients, the owner doesn't frantically buy random food to replace it within 5 minutes. They accept the variance and move on. Deception of certainty. Why do smart individuals, often with advanced degrees and highly successful careers in other fields, fail so spectacularly in this environment? It is because the traits that make you successful in society, persistence, refusal to accept defeat, and the drive to fight harder when challenged, are the exact traits that ensure your destruction in the market. In a normal career, if something goes wrong, you work harder to fix it. If a project fails, you put in extra hours immediately. The market is an unyielding environment. It does not care about your work ethic, your intelligence, or your desire to succeed. It responds only to supply and demand. When you refuse to accept 2 losses and push for a third, you are trying to force the market to submit to your will. You are demanding certainty from an environment that is inherently uncertain. A professional trader embraces this uncertainty. They know that on any given day, their edge might not work. Don't take it personally. Don't try to prove the market wrong. Simply recognize that the current environment is not aligned with their parameters, and they step away. Decision fatigue and the depletion of willpower. There is a finite capacity to your analytical mind. Every decision you make, from scanning a chart to calculating position size, managing an open position, consumes cognitive fuel. This phenomenon is known as decision fatigue. When you start your trading session, Your clarity is at its peak, focus is sharp, and your adherence to rules is firm. However, after your first loss, stress begins to drain this resource. By the time you face a second consecutive loss, your cognitive fuel enters a state of critical fatigue. Under severe stress, this mental energy depletes at triple the normal rate. Your capacity to process risk objectively is degraded. Your mind is exhausted, even if your body feels charged with adrenaline. That surge of adrenaline is a warning sign of panic, not a sign of readiness. When decision fatigue sets in, the brain takes shortcut answers, skips the risk verification steps, it ignores position sizing rules, chooses the path of least resistance, which is always the execution that offers the fastest emotional relief. Two-loss rule is a mechanical firewall that shuts down operations before decision fatigue, causes catastrophic structural damage to your account balance. Paradox of random outcomes. To trade like a professional, you must thoroughly understand the concept of randomness. If you flip a perfectly balanced coin, the probability of heads is 50%. If you get tails 5 times in a row, the probability of the next flip being heads is still exactly 50%. Coin has no memory. Market, while not completely random, possesses a high degree of unpredictability in the short term. Your trading strategy might have a 60% win rate over a sample of 100 trades. However, within that sample, it is mathematically normal to experience streaks of 4, 5, or even 6 consecutive losses. Here is the paradox. While the losses are a normal statistical event for your strategy, they are an abnormal emotional event for your brain. The retail trader views 2 losses as a sign that their system is broken, or that someone is manipulating the market against them. The professional views 2 losses as a random cluster in a large data set. They step away not because the system stopped working, but because they know human psychology, cannot handle an environment of random outcomes when emotional equity is depleted. Shifting from proud to protective. This is how professional traders manage risk. Core transformation required to cross the bridge from a losing trader to a consistently profitable one is a shift in identity. You must transition from a person who wants to be right to a person who wants to protect their capital. Losing traders are obsessed with prediction. They want to show how smart they are by calling the exact top or bottom. When they are wrong, their ego is bruised, and the third trade becomes a desperate attempt to heal that ego. Professional traders are obsessed with protection. They view themselves not as market prophets, but as risk managers. Their capital is their inventory. Without inventory, the business closes. When they hit a 2-loss limit, their risk management protocol activates automatically, just like a circuit breaker in an electrical grid. They don't feel shame in stopping. They feel a sense of professional pride because they followed their structural protocol. Mirror of self-awareness. How do you develop this level of discipline? It begins with radical self-awareness. You must learn to observe your internal state as if you were an outsider looking in. Next time you experience 2 consecutive losses, pause before touching your mouse. Take a deep breath and observe your physical body. Is your jaw clenched? Is your breathing shallow? Are you moving closer to the screen? These are physical manifestations of psychological stress. They are clear indicators that your emotional capital is spent. Write down a rule and place it where you cannot ignore it. 2 losses, and I am a spectator. By enforcing this rule, you break the cycle of compounding errors. You stop the bleeding before it touches your core capital. You preserve your ability to return to the market tomorrow with a clear mind, unburdened by the emotional weight of yesterday's mistakes. Compound effect of discipline. Every time you follow your rule and walk away after 2 losses, you are rewiring your brain. You are training yourself to value discipline over instant gratification. This builds a profound form of confidence that cannot be shaken by market movements. Consider how this simple choice alters your path. A reactive trader ignores the 2-loss limit and immediately seeks a 3rd trade. This behavior creates a deep, erratic account drawdown that becomes mathematically devastating to recover from. Psychologically, it traps them in a cycle of permanent anxiety and intense self-doubt, leading to total account destruction within a matter of months. A disciplined trader stops immediately after the 2nd loss, preserving both their mental energy and capital. Their account drawdowns remain shallow, controlled, and easy to recover from through simple mathematical probability. This protection keeps their mind calm, objective, and process-oriented. By mastering the art of walking away, they ensure their survival and thrive in an environment where most fail. True success in the market is never about conquering the charts. It is about conquering yourself. The market is a mirror that reflects every unresolved flaw, every insecurity, And every hidden bias in your personality does not change for you. You must change for it. When you step away after 2 losses, you are not admitting defeat to the market. You are claiming victory over your own impulses. You are choosing long-term wealth over short-term emotional satisfaction. That is the hallmark of professional execution. That is how you stay in the zone. Protect your mindset. Respect the probabilities. And remember that the best trade you make today might be the one you choose to avoid. Thank you for watching this deep dive into trading psychology from Market Mind Edge. If this perspective helped clarify your own struggles on the charts, please like the video and subscribe to the channel to join our community of disciplined traders. Leave a comment below sharing your experiences with the third trade. Let's discuss how mastering self-restraint changes the game. Stay grounded, manage your risk, and we will see you in the next session.